If you're in your 30s, now is the perfect time to start investing, especially to create wealth well before retirement. You're in the ideal stage in life to take full advantage of the power of compound growth. Now, I started investing in my late 20s and made plenty of mistakes along the way. I want to share what works with you step by step so you can avoid these costly mistakes and get straight to the good part, achieving steady growth in your stocks portfolio. It's what we use to average over 30% a year in our Luxembourg-based hedge fund. Someone aged 30, starting with $20,000 and aiming for $1 million by 65, needs to achieve an annual return of 11.83%. Adding just $200 a month, you only need an annual return of 9.10% instead of that 11.83%. If you wait until your 40s to start, that number jumps to 16.94% annually. Still achievable, but you'll need to be far more strategic. Adding that $200 a month, you then only need an annual return of 13.86% instead of that 16.94%. So it helps to budget and make those much needed sacrifices. Now let's flip the script. If you don't invest at all, you'll need to save almost $29,000 per year for 35 years to reach $1 million by retirement. Wait until 40 and that number climbs to $40,000 per year, which is massive. See the problem? Saving alone won't get you there. You need a system that makes your money work for you. Your results will depend on 4 factors: how much you start with, how much you add each month, your annual rate of return, and how much time you have before retirement. But here's the key. Don't spend forever trying to figure out a system from scratch. Adopt a system that already works, one that's simple and repeatable. The system you follow must outperform the market. If the S&P 500 averages say 8 to 11% per year, you need a strategy that does so much better. So how do you find these high-performing stocks? You need technology. Too many investors ignore this, but it's crucial. Think about your own career. You use specialized tools to deliver for your clients. Investing is no different. You are your own client, so make the right decisions to deliver for yourself. With the right tech, you can build a routine that filters out the very best stocks every week. No more guesswork. Then you need the right broker account, one that gives you access to all the stocks and assets you need. And that's your foundation to build from. Once you've established a solid process, chosen the right tools, and have a right broker, which gives you full control over your portfolio, the next step is execution and developing an investor mindset. There's a lot of talk online about what an investor mindset really means, often from people who aren't actually, really good investors. The most important lesson I've learned about investing psychology is this: you can't approach investing with an employee mindset. Why is that? An employee trades time for money, as outlined in an agreement with an employer called a contract. An investor, on the other hand, makes money based on the plan they create and commit to for themselves. Ultimately, money is made in periods. You may excel as an employee or an employer or a business owner, but to succeed as an investor, you need to adopt an investor mindset. Investing requires its own unique skill set, one that must be learned, practiced, and ultimately refined over time. The key here is being able to shift seamlessly between earning money with an employee mindset and growing that money with an investor mindset. Once you master this shift, you're ultimately on your way. Now, as the saying goes, it's simple but not easy. The best investing techniques are straightforward to learn and execute, but success comes from playing the long game. It requires discipline and the resilience to stick to your plan, even through challenging market conditions. Many people struggle here, often jumping between strategies or ultimately chasing quick wins. But even when playing the long game, times have definitely changed where we can execute superior investing methods and make significantly more money. They say the key to making wealth in the stock market isn't timing the market, it's time in the market. Well, this conventional thinking has been taken as the status quo for a very long time, ultimately a lifetime really. and is rarely questioned. It had its time. As I just said, we have now evolved. We are better investors. Well, you have the potential to be if you make the right moves and decisions. The phrase is no longer, it isn't timing the market, it is time in the market. That is outdated. The new approach is timing the market to maximize time in the market. We know precisely how to time our entries, hold and compound winning stocks, and then exit when the market reverses. Money in the stock market is made in cycles. There are times when the market booms, these are called trends, and when as investors we hold and compound the strongest stocks to make money. And there are times when the market corrects. This is the time to stand aside and protect capital. Some of the biggest mistakes I see investors make is to stand aside when the market is rising, fearing a market crash and assuming it can't go any higher, and then trying to make money in unpredictable periods, thinking buying stocks for cheap is the right thing to do, as again, this is what we have been encouraged to do by all the misinformation taken as the status quo. Buying during corrections is when most people get burnt. Instead, a disciplined investor sits on the sidelines when the market is choppy. Then when the bull trend resumes, we jump in with no losses to recover, only further upside ahead. This strategy relies on the ability to identify stocks with strong profit potential. Each year, I analyze over 50,000 stocks to select the very best performers for my portfolio. In this video, I'll show you how to pinpoint profitable stocks and build a portfolio that grows consistently over time. You'll love it.